Hey guys, welcome. I've got another video for you today on a SPAC merger. This one is FUSE, ticker symbol FUSE. And these guys are looking to merge with MoneyLion, which is a fintech provider. They've been around since 2013. And they're in kind of a unique market space. They have a particular target market that they go after, which kind of makes them a little bit unique. And so I want to get into that. I want to tell you the story behind the company. I want to tell you about the deal. I've got a bull and a bear case on this one. So I've got some points in favor of the deal and the company. I've got some points that are not in favor of it. So I want to try to give you guys a balanced, fair analysis or assessment of the entire thing. And if you stick around to the end, I'll sum it all up and I'll give you my opinion on which case I think is stronger. So let's get into it. Okay, so let's take a look at the transaction first. There's an overview here, and I've pulled some data out of this. The SPAC itself is valuing the company at $2.4 billion, so middle of the road for a SPAC deal like this. The company here is going to get $526 million injected into the balance sheet, and so that's going to give them some capital to execute on their growth plan. I don't want to get into some specifics of that a little bit later. They have 76% ownership retained post the deal for insiders, which is a pretty good number. Always like to see that ownership remaining. And that kind of, decreases the amount of dilution that you might expect coming out of the deal. They're going to close this one in the first half of 2021. We don't have an exact date yet, but for all intents and purposes, the deal does seem to be on track at the moment. Now, this SPAC is backed by a couple of guys that have some fairly deep financial experience. They are, to some extent, old school banker types. If you look at their bios and read up on some of the things that they've done, there's a quick summary here, in terms of Jim Ross, John James. These guys, I think, are folks that have deep experience in banking. They've got a foot into technology. And so they're able to bridge that gap, I think, between fintech and traditional banking, at least to a degree. So, this is a point in favor of the SPAC deal, I think, the fact that these guys do have some fintech experience and deep banking experience and finance and investment experience. So I think they're able to bring some expertise to the deal. That ticks a box for me. Like to see it. Now, I particularly like this slide here where the SPAC is outlining why MoneyLion fits their criteria that they were going after in the first place. And I like some of the boxes that they're checking here as well. They are pointing out the fact that MoneyLion does offer differentiated products or services that are unique. And that's correct. I'll get into some of what those are later in the video. They feel that MoneyLion is at an inflection point and they can actually sort of turn around this business and move it into a new direction. That can be both good and bad. I want to talk about that a little bit later as well. They claim that MoneyLion exhibits unrecognized value that can be enhanced. Again, they're pointing out a turnaround story here. Could be good, could be bad. I'll tell you what I think. And they claim that MoneyLion has demonstrated organic growth. I definitely would agree with that. I've seen some numbers in here that would indicate that they have experienced organic growth in the membership base and that they're capable of continuing to do that. So I do agree with that one. And they claim here that MoneyLion can benefit from being a publicly traded company. So this is a very important point. I always look for that in these SPAC deals. I ask myself, what are they going to do with the cash? Do they have a solid plan in place to actually grow the company and grow revenues and become profitable and all that kind of thing? And so I have kind of a mixed feeling on that one for this one, and I'll tell you why a little bit later in the video. So again, I like this slide. I like the fact that they're paying attention to these things. I don't necessarily agree with all of them, and that's what we're going to get into. Okay, before we get into the bull and the bear case, though, let's take a look at MoneyLion itself. What's the business model? What do they do? What kind of products and services do they have? And are they a good fit for the market that they're in? So MoneyLion is really a one-stop shop for all kinds of fintech services, which is a little bit unique. A lot of times we see these fintechs go after a particular space. Maybe they're a robo-advisor. Maybe they're more into wealth services, investment management, trading. Maybe they're more of a pure online banking play, and they're just looking at high-interest savings accounts and online banking and tracking of spending and all that kind of thing. MoneyLion is a little bit unique in that they do those things. In fact, they do all of those things, and they have some specialized products and services that are catered to the target market. I think if you look at their product lineup, on the left-hand side there, where they're into the robo-advisor space and wealth management and advisory services and personal finance education and all that kind of thing, that's rather unremarkable. I think that everybody does that. I think everybody needs to do that, so it's good that these guys have it. They have have a fairly solid offering in terms of online banking. The app is pretty good, and they're able to leverage the data that they collect on you from your online banking habits to develop and recommend other services. So that's a good one as well. And I do like this credit building thing that they do. And this is kind of something that they've done from day one. The value proposition being, hey, maybe your credit's not that great. Come to us, take out a small loan, pay it back on time. We will support our analysis of the loan application based on your spending habits and your data and your reliability and all that kind of thing, and help you build your credit back up. We'll charge you hefty fees in order to do that. So that's a difficult business. I think they've had some success with that. I think they probably will continue to, but I have kind of mixed feelings on that one. So MoneyLion defines their target market as middle America, the underserved people that traditional banks will typically ignore or have a difficult time doing business with. These are folks that often live paycheck to paycheck. They might have not the best credit. They typically work in blue collar industries, this type of thing. And traditional banks have had not a great relationship with folks in that particular market in the past. And so the idea here is that there's a fintech opportunity to drive additional services into a market where banks have not done all that well. And so the value proposition they're trying to bring to this market is this credit repair thing. It's microloans, it's personal finance education, it's moving these folks up the ladder in terms of wealth building, wealth preservation, and maybe getting them from the place where they're at in terms of that living paycheck to paycheck problem and into the habits of better personal finance, savings, and investing for the future. So I think it's a really good story. I like that story, and if they can execute on that and bring their customers along on that path, I think it's all good stuff.
What's the upside potential?
Okay, point number one that I like here is that they are going after an underserved market, right? And this is always a good thing. If you can find folks that want these sorts of financial services, but they're not getting them through traditional channels, either through banking or through the typical fintech plays that they see out there, then there should be an opportunity to go in and actually supply services to that market and make money while you're doing it. So point number two is the unique services that they are, in fact, offering to this target market. So one of them is this raw money thing. They're solving a real problem here that banks don't solve, which is the cash crunch that sometimes people will get into when they're living paycheck to paycheck. And so they offer a little service here where you can actually get your paycheck up to 2 days in advance with raw money. And they're really underwriting this, and they're managing the risk based on what they know about your spending habits and what they know about the reliability of the income that you've been able to generate previously. So they're able to sort of fill that crunch that a lot of people will often find themselves in when, suddenly they can't make the rent, they can't pay a utility bill, whatever it is. They can go in here and actually use a product like this to bridge the gap, which is pretty cool. This is a real problem that people have. And I think, a lot of them are turning to these payday loan places where they're paying ridiculous amounts of interest and they get caught in this cycle of debt. A product like this is really helping them stay out of that trap, which I really like. I like the fact that these guys are introducing new products. And so they have some new things coming in 2021. They have 3 of them that they're calling attention to here. One is payment flexibility, so people can actually finance purchases and pay for them over time. This has become wildly popular among a lot of fintech offerings. There seems to be enormous consumer demand for this. Merchants really like it because they're able to offer that installment option. I like this secured credit card story. That's a useful real world solution for somebody that actually needs to rebuild their credit and sort of establish that payment history of data. It's being established here with MoneyLion, but still they're able to actually extend credit to these folks, secure it, and, then monitor their repayment behavior. And if it's good, then they can actually offer additional services into them. So I think it's a really, really smart use of a secured credit card product. And finally, they're starting to offer crypto here as well. I think this is a marketing pull. I think they're sort of offering this to get some eyeballs on the company and on the products. I don't know exactly what's behind it. I don't know how profitable it will be, but certainly it positions them well for the future, right? I think that they're at least getting their foot in the door with respect to crypto and their ability to offer crypto-related products to their customers. I think people want this, even if they don't necessarily know why they want it at the moment. I think that'll become clear over the next year or two, and I think it's really key that these guys are offering it, so it's a good story. I said before that these guys are a one-stop shop for a lot of financial services, and I think that's a really, really key point in their favor. They are offering financial services that sort of span the entire ecosystem of what a customer wants and needs. And this slide sort of points it out, right? They're not only into everyday banking and the next paycheck sort of services, but then through that sort of financial education that they're offering to their customers and repairing their credit, getting them onto savings and investment plans, they're then able to leverage additional services into them. The last point here in the bull case is that I like the growth story that they've been able to recognize to date. Their year-over-year growth in revenue has been really good, and it's even better if you look at the year-over-year growth in their subscriber numbers. They've actually got a lot of people signed up to the platform, and it's growing at a really, really good clip. So I think they've proven the fact that they're able to pull customers in the door. I'm a little bit less confident in these growth numbers given all the adjustments that are applied to them, and I'll get into that in the bear case.
Let's talk about risk.
So point number one here is that a lot of their growth is based on their ability to upsell customers on additional services. Once they get all this data in place, right, they can sell you additional things. I like that idea. Of course, that's what you want to do. I'm just a little bit skeptical on their ability to sell additional services into this particular target market. Are they going to be able to execute on their plan to bring customers along and sort of grow their wealth and then leverage them for additional fees and additional services? It's kind of difficult to upsell folks on premium services and extract premium levels of fees from them when they do in fact live paycheck to paycheck. They're high risk in terms of credit and all that kind of thing. The next point here is that they call attention in their investor presentation to the fact that they are selling their credit risk to a third party. And that's true. And that's very common among banks, right? So what they'll do is they'll take the loans that they've actually advanced to their customers, they'll package them up and they'll resell them to somebody else. So somebody else is then investing in the credit risk associated with those loans, and that risk is off the books basically for the individual company. The interesting thing here is that they are selling these receivables upstream to an investment fund by the name of... The interesting thing in this particular case, though, is that they're actually selling these receivables, these bundled credit products, upstream to a fund called Invest in America Credit Fund. This fund is actually managed by the CEO of MoneyLion. So, you know, it's really just moving money from one pocket to another. It's moving risk from one bucket to another. Is it really insulating MoneyLion from that risk? I'm not sure that it is. And, you know, this is a crowdsourced investment model into Invest in America. So, you know, they're pulling in private money from accredited investors and using that to purchase this credit risk and this debt from MoneyLion. I'm not sure how sustainable that model is over time. The next point here goes back to growth. And, you know, these SPAC companies, when they put out these growth projections, they will always put pie in the sky numbers that are absolutely nutty sometimes. But this one really stands out in terms of its nuttiness. I think that they've had some really good year-over-year growth numbers to date. You know, even in 2020, they were able to execute on some pretty good growth, but then they're projecting completely astronomical growth over the next few years, you know, 79%, 74%, and they're not really clear on how exactly that's going to happen. You know, they're implying here that it's going to happen because of this public money. This deeper access to capital markets will allow them to execute on their customer growth. So really that's their growth vector, right? It's additional subscribers being brought into the platform, a little bit of this premium upsell and stuff like that, but they're not tying any of that to the actual numbers here. What are they going to do exactly? The next point here is this idea of reconciliation to non-GAAP financials. This is not totally uncommon. You do see this in these companies, especially if they're trying to paint a really good story in terms of their turnaround picture, because maybe the last few years haven't been all that rosy. And so that's kind of what I think is going on here. So basically what they're doing is they're saying, look, you know, our real financials were this, but you know, if you were to remove all of the real expenses and then only add back the ones that we think were relevant to our new business model, oh, look at that. We actually made money in 2020 instead of losing money. So this is not great. You know, I get the idea. It's saying, look, those expenses really were irrelevant. They were incurred for some other reason. They don't have a direct contribution to the projected profit that we expect to make. But at the end of the day, those expenses happened, right? And you'd have to really put a solid business case out in front of me to convince me that similar expenses are not going to be incurred in the future. And the last point I'll just say here is that these guys are not really a bank. They're actually get all of their core banking services from a company called MetaBank that's sort of providing the back-end core banking functionality in a sort of a white label view. And what this means is that MoneyLion is a little bit shallower than you might think in terms of their vertical integration within fintech. They don't really provide or have any of that core banking functionality on the back end. And that's not great. I would rather see them to be a deeper, more vertically vertically integrated company within fintech. The risk there is that MetaBank is going to change something, or they're going to be subject to additional regulation or something like that that could collide with the business model MoneyLion is trying to develop, and suddenly they've lost a back-end banking provider for their core business. I think that's a pretty key risk item, and if that were to materialize, they could be in real trouble. Okay, guys, let's sum this one up. So basically on the bull case, I think it's all about the product, it's all about the service, it's all about that target market. I think there's a really good story there, and I think these guys have a handle on good products that they can deliver into that customer base. On the bear case, though, I think the risk is all about execution. I'm not 100% convinced they can do the things that they claim to be doing. I think they're going into a really, really difficult market and a difficult business. I don't like this turnaround story that the SPAC is putting out there. I don't like this restatement of expenses and non-GAAP financials in the numbers. That smells like they have struggled in the past to me, and they're trying to turn things around and go forward. So for that reason, I'm going to say that the bear case wins here, and personally, I would stay out of this one. So guys, that's the story. I hope you like it. Please give the video a thumbs up if it did. It really, really helps the channel grow, and I really appreciate it. Don't forget to subscribe, ring the bell, and I'll see you on the next one.